Okay, so welcome back to the trading desk. What we're going to do now in video 4 is start to look at some basic computational methods used in the Forex market. And these basic computational methods, because it's all numbers based, we're going to start really understanding the quantitative situation behind the Forex market. It's very important to understand this and have mathematical rigor in your analysis for various reasons. Firstly, the most important one is that we learnt in video number 3 that hedge funds and pension funds are taking, as investors in the Forex market, a much more fundamental approach and analysing fundamental drivers and predicting the future. Well, if you ever want to go and work for a hedge fund or a pension fund or even an investment bank prop desk, one of the first things you're going to have to do is basically get this foundation and understanding of the basic computational methods. So if you are serious about having a career in the industry, this is something you've really got to learn very, very quickly so you can call on it whenever you need to make decisions in the Forex market. Now, as a retail trader, what you're going to find when you go into the retail trader industry and start dealing on retail brokerage platforms and interacting with retail brokers, you may get a few snippets of basic computational methods. And what you tend to find is that retail traders think, when they've learned a little bit of this and combine that with technical analysis and trade on charts and use very, very basic computational methods, they think this taken together and maybe trading on one economic number that comes out once a month, like the non-farm payrolls number. They tend to think that mixing this type of trading strategy with some basic understanding of computational methods overall is enough to rely on to enable you to become a decent Forex trader or a Forex trader that's consistently profitable. And it's obviously not the case, because as we know, 90% of retail traders lose 90% of their money within 90 days, and the numbers are actually slightly higher in the Forex market. So what you're going to see a lot of in the retail market is that brokers will push some of these basic computational methods, and once you've got a slight understanding of it, the brokers always kind of give you a pat on the back and say, you're now a Forex trader. It's completely wrong. Obviously, just being able to do a few sums doesn't mean you're a Forex trader. It's just part of a foundation and understanding that if you went to work for a hedge fund or an investment bank prop desk, that you'd have to call on to enable you to help make decisions later on. It's just having some mathematical rigor to enable you to do that. So let's go into video number 4 and go over to the computer screen, and I'll see you at the end of the video for a recap, and you'll see that everything starts linking together.
Okay, so welcome back to the computer screen. What we're going to look at now is some basic computational methods in the Forex market. And we're doing this to continue to build out our foundation. And it's absolutely necessary that we understand all of these computational methods, because in the bigger picture, as traders, what we're trying to understand in any market is what the opportunities are and what the risk is. And we brushed over this earlier with regard to volatility, that the volatility of any asset in any market at any one time over any given time horizon, that volatility basically tells us as traders what the opportunity is and the risk is in that asset. Now, if we're going to achieve this later, we really have to understand the nuances of the Forex market and what calculations we need to understand to form a computational foundation and understanding of how the Forex market and the mechanics of the Forex market actually work. So the first thing we're going to do is look at the left to right convention. And the left to right convention, if you've been around the Forex market for a while, you'll probably be quite aware of the left to right convention. But if you haven't been in the Forex market at all, it's quite important to understand this. And it's never a bad thing to go back to look at basic calculations in the Forex market and understand the mechanics of those calculations. Because when things go wrong in trading, and invariably they always will at some point, no trader ever has a 100% win ratio where they win on every single trade for the rest of their career. When things go wrong, people do tend to panic and do silly things, make mistakes. And when you've got a very solid foundation in understanding the basic calculations and computational methods in Forex, when you've got that solid grounding, you can have confidence. And, we know from earlier that it's a fact. 90% of retail Forex traders do lose money. And a lot of retail Forex traders think that because they know a couple of basic computational methods and they combine this with some technical analysis, so maybe they know how to work out their P&L, or they know how to work out a cross rate, for example. They think because they know this and combine it with technical analysis that it's going to make them profitable. Well, it doesn't. What it's supposed to do is give you a solid grounding and understanding of what the numbers actually mean and what's behind them, and build a foundation so you can actually build real systematic processes and understand volatility and opportunities. So the first thing we'll look at is the left to right convention. And we'll go back to this if you've been around the Forex market for a while, and just go over it. It never hurts. And if you're new to Forex, then being fresh to this, if the explanations are done pretty well, you'll understand this stuff straight away. And you should try to go over it quite a lot and just do exercises and try to make sure that it's cemented in your mindset so it becomes second nature. The left to right convention, trading currencies, everything is expressed in terms of left to right. So how much the currency on the left is actually worth. So if we look at an example here, let's first look at a dollar cross where we have the US dollar against the Japanese yen, and it's quoted as 119.786. Well, this basically means that $1 US, the currency on the left, buys 119.786 Japanese yen, the currency on the right. So when you see a quote, it's the currency on the left will be quoted as 1 unit buying the units on the right. And if we want to actually work out a cross rate from dollar crosses, we can actually take, for example, the Aussie dollar, US dollar, which is currently trading at spot 78095, which basically says $1 Australian buys spot 78095 US dollars. We can take this and the US dollar Japanese yen rate, and we can work out what the Aussie dollar Japanese yen cross rate is from these two pieces of information, from the two numbers. And all we have to do this is multiply the dollar yen rate by the Aussie dollar US dollar rate. And that gives us 93.547, which means $1 Australian, the currency on the left, buys 93.547 Japanese yen. Now, what you can do is go back to video number 2 and download the spreadsheet that we showed you earlier, and we can go over to this now. The spreadsheet that's called Tradable Crosses Opportunities Ranked. And you're going to see that a big table here of currency crosses, that this can actually be used to work out cross rates. So the example that we looked at here in the presentation just a second ago was dollar yen and Aussie dollar, US dollar. So 2 US dollar rates. And we worked out the Aussie dollar yen rate. Now in this situation here, where we have the currency on the left that we're trying to work out, and the currency on the right that we're trying to work out in terms of this currency here expressed in terms of this. When we have this situation where the currency that remains becomes both the numerator and the denominator, in this situation the convention is to multiply. So we take the US dollar yen rate and multiply by the Aussie dollar US dollar rate, and we get the rate here. Now the cells we referenced were C7, so up here, column C, row 7. So we took the US dollar Japanese yen rate, and we referenced L5, so column L, row 5, we referenced here. And we multiplied them together to get the Aussie dollar yen rate, because the currency that remained became the numerator and the denominator. And that's a multiplication situation. That gave us the Aussie dollar yen rate. And if we check on the Aussie dollar yen rate, so we look at the Aussie dollar at the top here, and we scroll down to Aussie dollar yen, and we'll see that we're actually correct. Now, what if we wanted to do something else? What if we wanted to actually work out the reverse of this? So the Japanese yen Aussie dollar rate. So Japanese yen being on the left-hand side and Aussie dollar being on the right-hand side. How would we do that? Well, the easiest way to do that is to take the result that we got earlier for Aussie dollar buying Japanese yen, and we have to work out the reciprocal, so the reverse of this equation, so the reciprocal of the result. And if we just work out 1 divided by the equation that we had earlier, we work out the opposite situation. And that gives us 0.010714. And if we check in the table, Japanese yen first and then Aussie dollar, we get this result here. Now, what if we looked at a different situation where we looked at the US dollar, Sing dollar, and the euro Sing dollar exchange rates? What if we wanted to actually get from these two results, these two exchange rates, what if we wanted to get the euro dollar rate from these two cases here? Well, the currency that's left out, the Sing dollar, in this situation is the denominator in both terms. So what we're trying to use here, we're trying to work out the numerator. And if we look at the cells that we're referencing US dollar, Sing dollar. So the US dollar, Sing dollar, which is all the way down here, 1 spot 3788, cell C27. And we're referencing the euro Sing dollar, which is next to it here in cell D27. Well, the convention here is if the currency that's left is the denominator in both circumstances, we can work out the new cross rate, or the new dollar cross, by dividing. So we divide the currency that's going to be first, the euro cross rate, by the currency that's going to be second, the dollar cross rate. And we get 1 spot 088732. So if we check in the table the euro dollar rate, we can see here that it's correct in cell D5. Again, if we want to work out the reverse of this, all we have to do is work out the reciprocal. So 1 divided by the formula that we worked out earlier. And that gives us spot 9185. So now we're going to look at what is the US dollar euro rate in the table. And we can see here that we're correct, spot 9185. Now if you want to do a bit of practice in your own spare time, what you can do is actually go and create your own currency tables. And then use these formulas to basically fill in the cells. So this is some homework for you. We're not going to be in this course spoon feeding you with everything. What you need to be doing, and we're going to come on to this principle later in a lot more detail, what you need to be doing is taking our resources and building on them yourself. So it wouldn't be good of us in terms of teaching to provide you with a currency table where it gives you all the formulas and you just type things into cells. If you really want to understand the mechanics behind numbers, it's great to actually do the data mining yourself and work out the formulas. So we've given you a nice example here of the conventions. So if you want to go ahead and work out everything in your own spreadsheets, that'll be a great thing to do for you for homework in terms of understanding the mechanics. So the left to right convention, it's pretty important. Just make sure you understand the left to right convention, how everything is expressed in terms of the currency on the left. The currency on the left itself is known in the Forex market as the base currency, and the currency on the right is known as the quote currency. So the base currency on the left, the quote currency on the right. And when we're going long a currency pair, we want the currency pair to go up. And when we're going short a currency pair, we want the currency pair to go down. So if we look at the dollar yen here, for example, the dollar yen back here was buying, the dollar was buying 102 yen. Much further down the line, the dollar is now buying 119 yen. So the dollar buys more yen. We want this exchange rate, if we're long, to go up. Conversely, if we're short an exchange rate, we want it to go down. So in this situation, 1 Aussie dollar bought around this time here $0.936, and we're short this currency pair, and it goes down, and now 1 Aussie dollar only buys $0.73. So the Aussie has gone down in value against the US dollar. In this situation, we've got the the Aussie dollar yen, the cross rate, and that's basically the multiplication of these two. So have a look yourself at currency charts, because the charts will just show you a pictorial display of the numbers, and you'll be able to see how cross rates, when you work them out in spreadsheets, exchange rates when you work them out in spreadsheets, how they link together, and how the charts actually link together as well. And this is actually pretty important stuff, because if you've inferred what's going on behind these numbers up to this point, then you will have worked out that, for example, if something very bearish happens to the Japanese yen, so there's a big, say, negative economic fundamental occurrence for the Japanese yen, and there's a very bullish occurrence for the Australian dollar, then you would be doing a suboptimal trade if you actually bought dollar yen and bought Aussie dollar US dollar. What you'd be better off doing, you would optimally create a situation for yourself where you make a higher return if you actually buy the Aussie dollar Japanese yen exchange rate. Because if you put these two trades on, you're buying the dollar here and you're shorting the dollar here. So the optimal trade is obviously not to throw capital at those two situations. It's to throw the same amount of capital at the Aussie dollar yen cross rate. That's how you optimize that trade. If there's something materially bullish occurring in Australia economically and fundamentally, and something materially bearish happening in Japan. So when we move on to the systematic process later, we're going to be looking at this a bit more closely in terms of optimizing trades fundamentally and optimizing from a capital commitment perspective. But let's continue to build out our foundation in computational methods, and let's look at one of the computational situations in the Forex market, which is called pips, or pip values. So in the Forex markets, currency pairs are basically expressed in unit sizes, and those unit sizes are called pips. And every tradable currency pair is quoted to 4 decimal places in our tradable set, except for the Japanese yen and the Indian rupee. And those currencies, the crosses that relate to those currencies, are quoted to 3 decimal places. So, for example, the sterling US dollar is quoted here as 1.5358, so to 4 decimal places. And the dollar yen is quoted as 119.693, so to 3 decimal places. So if you're quoted to 4 decimal places, if the currency pair is quoted to 4 decimal places, 1 unit size, 1 pip, is equivalent to spot 0.0001. So for example, if you bought euro dollar at 1.1174 and then sold it at 1.1274, you will have made 100 pips profit. So you just minus 1.1174 from 1.1274. And for Japanese yen and Indian rupee, 100 pips is basically equal to 0.100, and 1 pip is spot 0.01. So, for example, if you went short the Euro Indian rupee cross rate at 69.267 and then bought it back at 69.167, you will have made 100 pips. So you basically minus 69.167 from 69.267, which basically equals 0.100, which in this example, because we're using the Indian rupee, is 100 pips. Now, it's important to appreciate and understand pips and pip values because when you're sitting at your computer screen and you're on your retail Forex broker platform, your trading platform, you're going to see everything expressed in terms of the left to right convention and expressed in unit sizes of pips. But there is a problem with calculating everything in pips, because pips are not a base situation for drawing comparisons between currency pairs. So what you're going to find is that retail Forex brokers are going to actually try to calculate or make people try to calculate everything in pips, because it masquerades the true moves in Forex when you compare currency pairs. If you calculate everything in pips, it's misleading because it doesn't base everything to a transferable or comparable metric like a percentage. So above, in the example with euro-dollar moved higher by 100 pips, and we also looked at dollar Indian rupee, and that moved lower by 100 pips. So they both moved by 100 pips, but the moves clearly are not the same. If the euro dollar appreciates 100 pips in the example above, 100 pips in this example is actually equivalent to 0.895%. So if we work it out in a percentage terms, so we take 1.1274 minus 1.1174 divided by 1.1174 and then multiply by 100, we get the percentage move in the currency pair. And this is expressed in terms of basis points. And a basis point, we have the definition at the bottom of the screen here for you. A basis point is equivalent to 1/100th of 1%. So basically 1% equals 100 basis points, or 0.1% is 1 basis point. And when we compare this euro-dollar move in basis points to the dollar-rupee move, we can see the euro-dollar move was actually a much bigger move. So when we look at dollar Indian rupee, the percentage move was 0.144%, or 14.4 basis points. So the current price, if you work it out in euro-dollar, if you work it out, the current price, we can work out from that what 1 pip is equivalent to in basis points. So in euro-dollar, 1 basis point is equal, 1 pip is equal to 0.00895. And in dollar rupee, 1 pip is equal to 0.00144436. So it's equal to 1.44 basis points. So you can see that basically if you put the same amount of capital into both trades, so let's say you put $100,000 on euro-dollar and $100,000 on dollar Indian rupee, if you got a 100 pip move in euro-dollar relative to dollar Indian rupee, you're actually going to make a much higher basis point return, so percentage return. So from an opportunities and risk perspective, what we actually have to do is convert everything to percentages. And this is the only way we can actually draw comparisons on a level playing field. And what you're going to find out there in the retail brokerage industry is that all information that gets sent to you, or let's put it in a more nastier term, the information that gets constantly drilled down your throat, everything will be calculated all the time in pips. And as professional traders, we find this a bit weird, and it raises questions and red flags. Why do you calculate everything in pips? You'll often see in the broker's promotional materials, like in seminars, emails, video updates, you'll see them quoting everything in pips. So they might say, for example, that the Indian rupee fell 100 pips against the US dollar today. And it obviously sounds a lot more impressive. It sounds like a much bigger move than saying the rupee fell 1/100th of a percentage point against the US dollar today. And that's because their agenda is to always try and make you believe that there's opportunities to make money in the Forex markets every day, and that you'd be a fool not to trade Forex or even day trade it. And that's, as we know, because they have this structural conflict of interest. Professional traders and hedge fund managers just don't fall for this nonsense and assess all opportunities and risk by assessing volatility. And the only way you can assess volatility on a level playing field and on a comparable basis is to do it in terms of base metrics, so in percentages and basis points. And this is something we're going to be using a lot later in the video series. We're going to be looking at volatility very soon and calculating everything in percentages and basis points, so we can actually compare currency pairs and the opportunities and risk that they present to us, all relative to each other. So the unit size of Forex pairs in the currency markets is calculated in pips, but you do not make the mistake and do not fall into the trap by thinking that opportunities and risk should be calculated in pips. That's just extremely amateur, and it's something that all retail brokers and retail educators who are in bed with the brokers, who have the contracts with them, where they get a rebate on commission and volumes, it's what these guys want you to believe because they have an agenda. But we do things properly. We want to be professional traders here, so we do what professional traders and hedge fund managers do, which is calculating everything in percentages and basis points and capturing and understanding volatility. So we understand the basics there of pips versus percentages and basis points. So let's just leave that there. We're going to come back to volatility later. Let's have a look at trading sizes. Now, trading sizes is a funny one because actually across different platforms, Forex trading sizes can vary. So depending on what instrument you're trading, spot market, futures, CFD, spread betting. Universally, however, there are languages where trading sizes are broken down into three main units of size. And the three main ones are one lot, one mini lot, and one micro lot. And there may be a fourth one, depending on the retail brokerage platform you're using and what instruments you're trading. There may be another one which is a nano lot. Now, one lot basically is 100,000 currency pairs. A mini lot is 10,000 currency pairs. A micro lot is 1,000 currency pairs. And a nano lot, which, depending on the platform you're on, is 100 currency pairs. Nano lots tend to be available in the UK, Europe, and Asia. In the US, not so much. But depending on your brokerage platform, there'll be a variation of the measurements in the terms of the broker's own contract sizes, depending on the product that you're trading and the platform that you're trading. So it's pretty important that you have a foundation of understanding of what the different sizes are so you can apply this to any trading platform. So one lot, 100,000 currency pairs, one mini lot, 10,000 currency pairs, one micro lot, 1,000 currency pairs, and a nano lot, 100 currency pairs. So what do we mean when we are talking about the sizes of currency pairs when we reference 100,000, 10,000, 1,000, and 100? Well, these are basically standard sizes, and they can be applied across all trading platforms, and it's the language used to describe the size. So if you go onto a trading platform and the currency pair, the size that they trade is a 100,000 size, then you would just simply call this in language one lot, and the same applies to the others. And the easiest way of figuring out the size of a contract on a broker's platform is just to work it out using the pip values that are assigned to the currency pair on the broker's own platform. So when you see on the broker's platform this situation here, you need to look for the broker's unit size in terms of pip values. So you might see the following kind of quote here, where it says in euro dollar per 0.0001 CFD. And what you do is you divide 1 by this value, and this gives you 10,000 worked out in the base currency. And we know that 10,000 in the base currency is equal to 1 mini lot. And the bid ask at the time in this situation was 1 spot 10355 to 1 spot 10365. So we basically have a 1 pip spread. And we're selling at this price and buying at this price. This is the quote. So the contract quote on the platform is quoted as 1 pip or as a mini lot of base currency. And the trading size is the amount of the left base currency bought and sold. However, the exposure and P&L that you'll see on the trading platform, and this is another convention that you need to make sure you understand, the exposure and P&L is going to be expressed in the terms of the currency on the right. So that's how you work out a trading size on a broker's platform, and that's pretty universal. So you can apply that on pretty much any platform in the world. Another example, so let's have a look at a lot smaller situation, so a nano lot. If we're looking at dollar yen, for example, we can see that a pip value here is spot 0.1. So 1 divided by spot 0.1 is $100 US, and that's equal to what we use in terms of language in the Forex markets. That's equal to 1 nanolot. So the bid ask at the time in this situation is 119 spot 965 to 119 spot 975. So this provides a 1 pip spread to the Forex pair dollar yen. So if we bought 1 contract of dollar yen, we'd be buying US dollars and selling yen at a rate of 119 spot 975. So we buy at this price and sell at this price. And the exposure and P&L, as in the previous example, is going to be worked out on the right-hand side currency. The contract quote on the platform is quoted as 0 spot 0.1 or as a nanolot, and this equals 100 of the base currency. So we know that if we work this out, $100 times 119 spot 975, this is equal to 11,997.5 yen. So again, the trading size is all in the amount of the left currency, the base currency, that's bought and sold. However, the exposure and P&L is expressed in the terms of the right currency, the quote currency, that's bought and sold. So imagine if we calculated our pip value here incorrectly in this example, and let's say we wanted to have an exposure in this currency pair that's equivalent to 1 million Japanese yen. Well, if we miscalculated the pip value, what we may actually end up doing is, instead of trading an amount of mini lots, we may end up trading the same amount of lots in the currency pair. So we can go through an example here just to highlight this properly. We've got a table here where we have all the pip values from a typical trading platform. And this table here can be applied to pretty much every trading platform in the world when it comes to Forex pairs. But dependent on your broker and dependent on the product that you're trading, you may have to change the pip values and therefore this calculation here. So make sure you do your homework on the broker's trading platform before you actually trade. As a retail trader, you're more than likely to only be dealing in mini, micro and nano lots. Lots are really for institutional level traders at investment banks and hedge funds. But it is important to get it right so you basically avoid this mistake, this basic mistake, because you can end up in a situation if, for example, it's a fast market and you're losing money, making the wrong choice and not working this out correctly. And you know, lots are in the size of 100,000 base currency, and instead of, for example, buying 10 mini lots and having the intention of taking 100,000 exposure, you could end up buying the equivalent of 10 lots, so 100,000 exposure. So let's have a look at an example. If we use the above example of euro dollar, let's say we intended to have the equivalent exposure of 50,000 euros. So we wanted our trading size to be 50,000 euros. But instead, we calculated the lot size incorrectly, and we ended up buying 500,000 euros. The correct way, if our intention was to buy 50,000, is to buy 5 mini lots, so going long 50,000 euros, and on the other side, our exposure and our P&L will be expressed in US dollars. So this is equivalent to 55,178 US dollars. Or we work this out as 5 contracts, 5 mini lots, times 1 divided by 0.0001, the pip value on the broker's platform, multiplied by the exchange rate that we buy at. And that is equivalent to the 55,178 exposure. But what if we got this wrong and we calculated the pip value incorrectly and we worked it out as buying 5 lots? And we did this at the exchange rate, 1.10365. We end up actually going long 5 lots, so 500,000 euros, or short 550,178 US dollars. We've now got 10 times the exposure that we actually intended to have, and instead of running that exposure and being fools, we're going to have to trade out of that straight away. So it obviously costs money. And, you know, if you're in a rush, you might not even notice that you've done it. And then it could go seriously against you and you could get in real trouble. So it's really important to get hold of this table and apply this to your own trading platform and make sure that you just get the basic computational method correct when working out trading sizes specific to your platform. So that pretty much takes care of trading sizes. There are other basic computational methods that we have to take care of as well. One of the most important out there is definitely margin, leverage and exposure. And we did touch on margin, leverage and exposure earlier when we were looking at the agenda of Forex brokers. And I say this is important because what you're going to find in the retail trader market is that Forex brokers are much more willing to lend you money and lend you more money to trade than in any other product, so any other asset class, such as indices, stocks, commodities, ETFs, and interest rate products. And there's a reason for this. It's because the volatility in major Forex pairs and crosses in the typical tradable instruments on brokers' platforms, the volatility is much lower over any given time period, and liquidity is much higher in Forex pairs than in any other asset class. And you've got to ask yourself the question, if volatility is lower and liquidity is higher, then it's pretty obvious that the broker has less risk, especially if they're taking the other side. So they can get away with lending you more in order to maximize their own spread. So the bigger you trade, the more they get paid on the spread. The financing, because they're lending you more money. So if you're running overnight positions, you pay financing. And the over-the-counter gain, because they're actually taking the other side of your trades. And on the 90% of people that lose, they're making a profit. So the bigger, the better. So it's a lot more it's a lot less risky to lend retail traders money if they're trading less volatile instruments. And Forex is much lower volatility and much higher liquidity than any other asset class. Therefore, it basically means the broker has just got much less risk for every unit of capital that they deploy in a Forex pair to a retail trader. So because they've got less risk, they can get away with lending much more. Well, if you're just the equal and opposite of that situation, then you're just a person who is trading the same instrument, and therefore you're trading something that's much lower volatility and much higher liquidity than every other asset class. Now let's just forget that we're actually trading an asset class called Forex. Let's just imagine any asset that's priced as follows. So the asset is priced at 1.2277 to 1.2278, meaning you can sell at 1.2277 and buy at 1.2278. So, and let's say this asset, the pip value is 0.0001, so it's got a 1 pip spread. And imagine that this asset just trades only twice a day. So it trades on the bid 1.2277, and it trades on the offer at 1.2278, and it does this every day forever. Well, if it does this every day forever, you have to ask yourself the question, is it possible to make money from this asset in one day? Is it possible to make money from this asset in 1 year? Well, of course not. The point's really simple. It doesn't matter how much money you throw at this asset, the asset just doesn't move. Now let's think about this in terms of a real Forex pair. So let's say you work out that the daily historical volatility of a currency pair is on average 60 pips. Now, will the currency pair move in the future more or less if you as the trader decide to borrow money in order to trade the currency pair? Well, obviously not. The currency pair is just the currency pair. It's the exchange rate as determined by the market. Just because you borrow money doesn't mean the opportunity to make money has increased. All you're basically doing is leveraging volatility that doesn't exist in order to give the illusion that it does exist. Historically, Forex as an asset class moves less than any other asset class over all time periods. And if you're using high amounts of borrowing, this just doesn't increase the volatility of the asset class. It just increases the volatility of your P&L. And this is just basic common sense. And you have to anchor yourself to common sense here, because there's an agenda out there to make you trade in as big a size as possible and to believe everything should be calculated in pips. Anyone who tells you that this is not true is just a liar or basically an idiot. The fact of the matter is they probably have a conflict of interest. And unfortunately, if you're the person that ends up believing these people, then you're going to end up being the idiot. So the dumb money that we talked about earlier. When we look at margin leverage and exposure across the globe, in the US and Canada, a margin requirement for trading Forex can be as low as 2%, but it varies massively across the States and Canada, dependent on the broker. I've seen margin requirements in Forex as high as 30% in the US and Canada, and as low as 2%. So it all depends on the broker and the product that you're trading. So whether you're trading spot or in the futures market. And in Europe and Asia, it's typically 1%. So what you're going to find is it's really just 1% across the board. And, we looked at an example like this earlier with a 1% margin requirement. This just means you're only going to have to put up, say, in the United Kingdom, £1,000 initial margin in order to borrow £100,000 from the broker to trade a one lot of sterling US dollar or cable. And basically what you're doing is you've ended up becoming 100 times leveraged. So if cable sterling US dollar rate goes up by 1%, you're going to make £1,000 and you're going to make a 100% return on your initial margin. If the cable rate sterling dollar goes down by 1%, you'll lose £1,000 and therefore you're going to lose a 100% loss on your initial margin. So you'll be wiped out and you'll get what's termed as a margin call. And we looked at this earlier. The difference between your initial margin and your current P&L is the variation margin, and the margin call is what you receive when you're wiped out and you have to put in more margin to your account to pay for the losses. Now, what's quite interesting is if we again look at things from the perspective of the retail Forex broker, because you may have noticed something as we've gone through this slide here, that the brokers themselves use these terms called initial margin and variation margin and margin call. And this is basically marketed as your risk. But what you have to remember is on the other side of this, there's a credit facility. And the brokers are measuring this risk themselves as well. So they have the equal and opposite risk to you because they're taking the other side. And if you're going on the broker's platform and they themselves in their own language are using and calculating risk in percentage terms, then why do you think they want you to trade and calculate everything, not on their terms, but in terms of pip values? So what you'll notice is that brokers themselves manage their own risk and opportunities to make money by measuring their risk in percentage terms. And they set margin requirements for all currency pairs across the board as percentages. So if pips are the most important measurement, why don't they use pips to decide how much they're going to lend you to trade for a currency pair? Well, they measure their own risk in terms of percentage, but they want everybody to think in terms of pips. And if they achieve this, they basically have thousands of dumb money clients who can't calculate their risk correctly, which is a perfect situation for them. So depending on the currency pair, so in developed, emerging, commodity currencies, non-commodity, dollar majors, crosses, etc., brokers globally tend to be between 1% initial margin requirement, so very liquid and less volatile currency pairs, and 5% initial margin requirement for less liquid and more volatile currency pairs. So they require you to put more money up for the riskier positions, and they calculate the risk themselves in percentage terms. And this is all just common sense, and it really angers me that people can't read between the lines and see that this goes on. Don't be fooled. Even the more volatile currencies across the Forex spectrum, so the more exotic volatile currencies are actually less volatile historically than indices, stocks, commodities, and ETFs. The brokers themselves set margin requirements according to the volatility and liquidity profiles of these assets in percentage terms, and professional traders do the same. And professional traders are doing this so they can beat the brokers at their own game. What you can do is go into the download section of this video, and you'll find a spreadsheet called leverage table, and you'll get a full breakdown of margin requirements, leverage, and risk. Okay, so if you go to the download section, download the leverage table. It's a pretty straightforward and basic spreadsheet, but understanding the basic computational method is really only the start. What you need to do is understand how to interpret this properly. Now, if you go to the margin call percentage cell, you will see that the margin call percentage is worked out as 1 divided by the exposure rate. That's all pretty straightforward, but what does that really mean? Well, the interpretation here is that if you are ever fully exposed, let's say the broker sets their margin requirement at 1%, and you decide you put $1,000 in your trading account, that means you can have up to $100,000 exposure. If you go fully exposed and the volatility of the asset that you're trading, so in this instance a currency pair, if the volatility of the currency pair over that time period, and it doesn't matter what time period it is, whether it's a day, a week, a month, a year, if the volatility is greater over that time period than the margin call percentage, then it just means you stand a very good chance of being wiped out in that time period. So that's something to bear in mind. Go through the Excel spreadsheet leverage table in your own time, and just make sure you understand the basic computational method of margin, how it's worked out, leverage and exposure, and just understand the principle of the volatility being transposed onto the risk of the broker's platform, so the risk that you're allowed to take. The principle is very straightforward. If you're allowed to take a certain amount of risk and the margin requirement is set at a certain level, if the volatility of the asset is bigger than the margin requirement or the margin call percentage, then you stand a very good chance of being wiped out. So just remember that and understand the basic computational methods. We're going to look a lot more into leverage and exposure and how you build trading accounts later in the video series. But for now, just understand the basics there. Now, what really matters in trading is not how much leverage you can actually get or what the margin requirement is. What really matters is what your gross exposure is. That's your real risk. That's how professional traders calculate their risk. The first thing they look at is their gross exposure and the volatility of the asset that you have a position in, or assets that you have positions in. So let's think of this in terms of buying a stock like Apple. It's a lot easier to understand with stocks. If you buy 1,000 shares of Apple at $125, your exposure is 1,000 shares times $125, so $125,000. If Apple goes down, so goes against you by 1%, you lose 0.01 times $125,000, so $1,250. Well, it's exactly the same when trading currencies as it is when trading stocks. We're simply using a base unit to work out our risk, so our percentages. So let's say we bought 5 mini lots of euro dollar at 1.10365. That's going to be 50,000 euros, so in base currency 50,000, and it's going to be in US dollars 55,178 US dollars, so in quote currency 55,178. And the broker, let's say the margin requirement at the broker is 1%. That means you'd have to put up a minimum of 500 euros. Well, that's totally fine, but it doesn't actually need to be 500 euros that you deposit in your account. What you could do is put 25,000 euros in your trading account, and you basically choose your own gross exposure level. Therefore, you're choosing your own leverage. So if you decide to put 25,000 in your account and decide that your position size is going to be 50,000 in euro currency pairs, so 50,000 in the base currency, then it means you've chosen your own leverage. You've decided that you're going to be 2 times exposed, so 50% margin requirement. And what you've got to understand is that it's very obvious that it's in the broker's interest that we get stopped out as frequently as possible. The more we get stopped out, the more we trade. And then the broker basically gets paid more commission. So if we decide our own exposure rates, as long as we put good amounts of capital in our trading accounts, it basically means that we could never get stopped out. And that's what we're trying to achieve here. When we looked at the previous slide and we looked at the margin requirement, and that margin requirement rate being lower than the volatility of the asset, we never want to be in that position because it means we can easily get stopped out. So the trick here is actually to choose your own exposure levels and do the opposite of what the broker wants you to do. And doing that will put you in a far stronger position because you'll be able to take positions knowing with full confidence that you will never ever be stopped out. So it's pretty important to understand these basic computational methods of margin, leverage, exposure, and what risk really is. Risk isn't how much you can borrow. Risk is the exposure that you've got, so your gross exposure. Now let's move on to our next section for computational methods, which is profit and loss. Now, there's various ways to work out your P&L when you're trading currency pairs, and all of them do get to the same answer, but you've got to get into the habit of knowing your exposure at any one time, so your real risk, and working out in percentages as well as in pips, because working out in percentages means you can compare opportunities and risk to other situations. And there's 3 main ways to work out your P&L when trading Forex. We're going to look at base and cents, pips, and we're going to look at exposure percentages and basis points. The first one is base and cents. It's all pretty straightforward. Here's an example where basically we buy 1 lot of euro dollar at 1.10356. So in base currency terms, we're buying 100,000 euros worth of the currency pair. And in quote currency terms, we're selling 110,356 US dollars. Now, if the euro dollar exchange rate moves to 1.12479, we would have made a profit of 100,000, so the base currency, times the difference between the price that we sell at and the price that we buy at. And if you work that out, that comes out as $2,123. And you can see that the profit is expressed in dollar terms. And this is always the case. The P&L and exposure, as we saw earlier, will always be expressed in terms of the right currency. So the currency on the right-hand side, the quote currency. Now, if your trading account is denominated in the base currency, so in this case the euro, then we basically use the current exchange rate to work out the profit that the trading account is going to make in the base currency terms. So the currency that the trading account is denominated in, because they're the same. So we take the profit, $2,123, expressed in the quote currency terms, and divide by the current exchange rate. So 1.12479, and we get to a profit of €1,887. So you can see that working out your profit and loss in base and cents is extremely straightforward. So base and cents is pretty straightforward. Now, if we work out our profit and loss in pips, how do we do this? Well, if you remember this table from earlier, we looked at the broker's pip values and we looked at trading sizes. And what's important when you're working out your profit and loss in pips is the pip value set by the brokers on your trading platform and working this out in terms of a currency value per pip. Let's look at an example. So here we've got the example of sterling US dollar, where 1 pip on this broker's platform in sterling dollar is equivalent to 0.0001. So you can see it here quoted on the screen. That means one contract is 1 divided by 0.0001, which is 10,000. So one contract equals 10,000. So 1 mini lot in base currency. The pip value on the platform, so we work this out. We take 1 contract of sterling US dollar. 1 contract. The pip value is 0.0001 times 10,000, and that gives us a pip value in dollars of $1. Now, if we trade 1 lot, so 100,000 currency pairs, this is going to be equivalent to 10 mini lots. So 100,000 base currency. The pip value will be as follows. It will be 0.0001 times 100,000. So we're basically just multiplying the pip value in dollars by 10. And you'll see that the pip value as well, in all cases, is in the size or denominated in the quote currency. Now, what happens if we do a trade where we buy 1 lot at 1.52518? So we're buying £100,000 and selling $152,518. And then we trade out of this position. So we sell 1 lot of cable, sterling US dollar, at 1.54622. So we sell £100,000 and buy at the new rate $154,622. Well, 1 pip in euro dollar on the platform is spot 0.0001. So we've made a profit of the difference divided by spot 0.0001, which is 210 pips. And then we multiply that by our pip value in quote currency. That gives us a profit of $2,100. If we then want to work out the sterling profit, we again, as in the previous example, we take the current exchange rate, and here we divide 2,100 by 1.54622, and we end up with a profit of £1,358, so expressed in base currency. So calculating profit on a currency pair by using pips and working out the pip value in the quote currency is pretty straightforward as well. And the way you can apply this across all trading platforms is by anchoring or taking the broker's own pip value on their platform and applying it across the currency sizes. So all you do is take the pip value and you fix it across all sizes, and you say, and you multiply across the sizes. So here, 1 lot as 100,000, a mini lot as 10,000, micro and nano, and you get your pip values expressed in quote currency here. So you can apply that table across all trading platforms. Now let's have a look at another example. we're going to look at a smaller one using pips. So we're going to look at dollar yen, where the pip value is different. Now, 1 pip on this broker's platform in dollar yen is spot 01, as you can see here. And 1 contract is basically therefore worth 1 divided by the pip value equals 100 or 1 nanolot in base currency. So the pip value on this platform, expressed in quote currency, when we're trading 1 contract of dollar yen, is 0.01 times 100. This works out as 1 Japanese yen. So if we trade 1 lot, which is obviously much bigger, it's going to end up being 1,000 pieces or 1,000 nanolots. So 100,000 in base currency, and the pip value is going to work out as 1,000 Japanese yen in quote currency. So let's say we buy 1 lot of dollar yen at 119.975 on the platform here. So selling 11,997,500 Japanese yen, and then we trade out of this position. So we sell 1 lot of dollar yen at 121.663. So we sell $100,000 and buy 12,163,300 Japanese yen. So 1 pip was spot 01, which means we've made a profit of the difference divided by spot 01, which is equivalent to 169 pips. So we'll just round it up to 169 pips times 1,000 yen is 169,000 yen. To work it out in the base currency, we just divide by the current exchange rate. So that, again, all pretty straightforward, and you can apply the same situation and work this out in yen by changing the pip value from the broker's platform into this table and then multiplying across by the sizes, and you get the quote currency, the pip value expressed in the quote currency. So all pretty straightforward. Now, what about if we do this in percentages and basis points? So let's take the same example of dollar yen. So we know that 1 pip is spot 01, and the contract value is 100 in base currency. And in quote currency, 1 pip is equivalent to the value of 1 Japanese yen. And if we trade 1,000 nanolots, so we're trading 1 lot, if we trade this size, it actually doesn't matter. It doesn't matter to the profit or loss in terms of working out, because we don't need to know the pip value. All we need to know is the profit or loss in percentage terms. So if we did exactly the same trade, all we have to do is work out what 169 pips is as a percentage of the exchange rate when we put the trade on. Multiply that by 100 and we get 1.4%. Or if we work out 1.4% of 100,000, we get $1,400. So pretty much bang on what our profit was before, $1,389. So you can work this out in exactly the same way, but the habit you've got to get into is working everything out or double checking everything in percentages and basis points. And that's going to give you a much better appreciation of the percentage changes over time of currency pairs. So if you think you're a hero because you made a certain amount of pips, when you work it out in percentage or basis point terms, you're going to realize that it's actually most of the time not a lot of money, especially if you're not a lot of return, especially if you're day trading. So get into the habit of working everything out in percentages and basis points for that reason, but also you're going to see as we move on to volatility that everything is about percentages, because we need a level playing field. We need to understand what these opportunities are and what the risk is when compared to other opportunities and other risk across the Forex remit. So when we're comparing currency pairs against each other. Again, working everything out in percentages and basis points was all pretty straightforward. Obviously, whichever method you're most comfortable with, you're going to use that method repeatedly. That's all totally fine, but do try to double check everything again with percentages and basis points. So let's continue with our computational methods. The next one we're going to look at is carry or rollover. And things happen when you take currency positions that you might not be aware of. When you actually take a position in a Forex pair, what you're actually doing is you're going long one currency and you're financing the purchase of that currency by selling or shorting another. And we've been through this earlier. You can't buy a currency without selling another one first. It's automatic. Now, when you're doing that, when we're looking at this thing that we call carry, what you're trying to achieve in making a carry is basically borrowing a low-yielding currency and lending or investing in a high-yielding currency. So you borrow at a low rate and you buy a currency that pays a high rate. And in your trading account, when you do this, it's all automatic. So the low-yielding currency is sold short automatically to buy the high-yielding currency. You're selling the currency short because you basically don't own it. So you're borrowing the position and paying the interest of the country that you're borrowing in order to borrow the position. And you then use this money to finance going long the high-yielding currency. And when you're lending, so investing in the currency going long, someone else has sold you short borrowing. So sold you short on the other side, and they're paying you interest. And holding the currency basically enables you to lend it to borrowers. It's all automatic because no one can buy a currency without first selling another one to finance it. So you pay interest on the short side of the trade and receive interest on the long side of the trade. And obviously the strategy here is to make money. So the objective is always going to be to borrow short positions in currencies whose country interest rate is lower than the country's currency you're lending, so investing in, because the country that you're paying to borrow, to you, that is a liability. And the country that is paying you, that to you is an asset. So you have a liability and an asset on each side of the currency pair. The currency you go short is a liability, and the currency you go long is an asset. Please remember that. It's very, very important. Now let's have a look at this in more detail. Like any of our other basic computational methods, it's pretty straightforward. What's actually happening is you're, again, receiving interest on the asset and paying interest on the liability. So the currency that you're long, the classic carry situation is that you're making more money on the long currency than you are on the short currency. So more than you're paying out. And this becomes a credit to your trading account. And the opposite of that is that you're paying a debit out of your account. So the phrase that we use, and this is where it comes from, the phrase that we use to describe the difference between what you're receiving and what you're paying out is the carry. And a positive carry is making money, so making a profit between the two. So the net effect is that you get a credit to your trading account. And a debit is termed as a negative carry. So if you're basically paying out more on the short currency than you're receiving on the long currency. Now, when you look at a currency in absolute terms on a trading platform, what you will see is that you will receive less on a long position in a currency versus when you short the same currency. And that's because the deposit rate for a currency when you invest is less than the lending rate, so when you borrow. And that's pretty straightforward and intuitive when you think about it. So if you go to a normal high street bank and deposit money in a savings account, it's pretty obvious that the rate that you receive on your savings account from that bank is going to be a lot less than the rate that they lend money out at the same bank. So if you took a loan from the bank, the rate is going to be much higher. What's actually happening there is the same as what's happening here. Same principle. If you go long a currency, you're basically receiving the deposit rate of the country of the currency you're going long. And when you go short, you're paying out at the country's loan rate. So there's a spread, there's a difference. And when you compare two currencies, what you have to do is compare the long rate, the deposit rate on your trading platform of the currency that you're going long, so what you will receive, versus the liability, the short, and the interest rate that you'll be lending the currency at, so the liability. And the difference is either going to be positive or negative. So it's either going to be a positive carry or a negative carry. So when you're comparing two currencies, it's obviously very important to know what the interest rates in each country are, so you get a good sense of what rates you will be paying, so whether there's going to be a positive or a negative carry. And you can actually check these on the trading platform. They'll be available in different areas of different trading platforms, but they should be available and they should be quoted. So it's probably best if we actually go through an example here. And what we've got here is a table, and it's a carry or rollover table. And we'll go into Excel in a second, but basically what really matters here is what we call the interest rate differential. So the difference between the interest rates across two currencies, and the interest rates being, if you're long currency A, the interest rate that you receive, and if you're short currency B, the interest rate that you pay, as in the interest rate that you pay on the loan. So let's go into Excel, and you can use this table by taking the loan rates and the deposit rates from your trading platform, and everything that you see in the grey here is an assumption. So you can change these assumptions whenever you want, and we've assumed 365 days interest, so a full year, and we've assumed an exchange rate of spot 94512. And we have currency A and currency B. Now the deposit rate for currency A is 1% and the lending rate is 4%. The deposit rate for currency B is 7% and the lending rate is 12%. These assumptions can be changed, so check your trading platform and you can actually use the numbers from trading platforms to see what interest rate over 365 days the broker has for their deposit rates and lending rates for particular currencies. So these assumptions can be changed, and so can these. Now what matters is the interest rate differential, so the difference between the interest rates. Now when we look to go long currency A and short currency B, So we're basically long AB. The interest rate differential from what we receive in deposit terms on currency A and what we pay out on currency B is 11%. So we just reference the cells here, G10 minus G11. Sorry, G10 minus H11. So we have the 1% minus the 12%. And this is equal to minus 11%. So if you do go long currency A and short currency B, what's going to kill you on this trade on an annualized basis is the 12% that you're paying to loan currency B. Now, if you were to do the opposite, so if we went long currency B and short currency A, which is essentially putting on the trade short AB, then we get a net credit to our trading account annually of 3%. Now, if we move further down in the table overall, you're going to see here are various trading sizes. And what we've done is work this out in dollar terms for the various trading sizes. So for example, if you went long one lot of currency A, short currency B, per year, you're going to be paying out from your trading account a debit of 11,000. And conversely, if you do the opposite, which is long currency B, short currency A, so basically you're short the currency pair AB, you're receiving a credit of 3,000 per year. If you're short one lot of the currency pair AB. So when you actually work this out, on a daily basis, so dividing by 365, what you actually get is the daily net credit or debit to your trading account or from your trading account. So if we have long the currency pair AB, as we have titled up here, we basically pay out per day 31.8869. And if we're short the currency pair AB, we actually get a credit to the trading account of 8.6964. And this daily debit or credit measurement is called rollover. It's the daily rollover that you either pay out or receive to your trading account. And we've worked it out here for the various trading sizes. So just remember that we have the debit and credit system worked out on a daily basis for the amount of one lot in each area for the currency pair AB. And you can see that as you start to increase the position sizing, so when you go from one micro lot to a mini lot to one lot, you can see that this can really start to add up. And what you've got to think about, similar to analysis that we were doing before in terms of margin requirement and margin call, and the volatility of an asset being overlaid onto those metrics, we concluded that over any time horizon, the volatility of the asset, so in this case we're looking only at currency pairs, the volatility of the currency pair has to be, if it's bigger than the margin requirement of the broker, and you're fully leveraged, so using all of the broker's leverage, it's obviously very easy to be wiped out. That's just the basic principle we looked at earlier of margin, leverage, and exposure. Now, with this situation, you have to start thinking in a similar way, because if you decide to go long the currency pair AB and you actually have no idea what the rollover situation is, so the interest rate differential worked out on a daily basis, then it's pretty obvious that if the currency pair, the volatility of the currency pair, doesn't move by this amount per day, then you can quite easily make nothing per day. And if you're very leveraged, you can get wiped out very quickly, because the currency pair can actually just stay the same price, and you can just pay this every single day without even realizing it, and this will just eat away at your margin, and you'll just get stopped out and receive a margin call. But if you didn't check and you were lucky, so you picked the right side of the rollover, and if you don't check, then it's obviously completely by accident, then in a leveraged trading account, you'll get paid this every day, and you could actually do quite well, even if the currency pair stays the same. So this principle of the volatility being transposed over to the rollover is quite important. You've got to check these things. So let's go back to the presentation. We'll come on to this section in a second. And we just have a little breakdown here. So basically, what's important is obviously the interest rate differential. And what you want, obviously, is to have a positive carry when you're taking a position, because if the wind is blowing in the opposite direction, then you're basically paying out every single day a certain amount. And what we're going to discover later also, which adds another layer to this situation, is that the interest rate differential between two countries, if it's decreasing or increasing, the speed and direction of what's actually happening becomes quite important as well. But for now, just understand the basics, that obviously a positive carry is much more preferable than a negative carry, and that you have to check your brokerage platform and make sure that when you're potentially putting a trade on, and that trade can be of decent size, and obviously most retail Forex traders are going to do this using leverage. And, if you leverage a lot, this can become very, very costly if you're paying out a large amount every single day and can eat away at your margin value. So what you'll be able to see on the brokerage platform is a table of the daily rollover rates. Now, if they're not available on your platform, then I'd suggest that you really have to contact your broker, because they do have a regulatory responsibility to tell you this information. What you might find is it's not on the platform, it's on the website, and it gets updated every week rather than every day. They may also send out a regular PDF, so it all depends on the broker that you use and what their processes are. But generally speaking, the larger brokers, the rates are going to be indicative of what the base rates are, or the interbank offer rates within the countries concerned. And what we looked at just then were rollover rates, assuming that we don't use any leverage. But now we're going to look at an example of what happens when we do use leverage. Okay, so let's have a look at an example of when we use margin. We're going to be looking at this table down here, and we're going to go over to the Excel spreadsheet that we looked at earlier. And it's a pretty basic, straightforward spreadsheet in terms of the computational methods used. It's all linear. So what we've got is another assumption, and this is the amount of margin that you put in your trading account. And down the left-hand side here, we have the various margin requirements. And we start off with 0.5% margin requirement, which is 200 times leverage, all the way down to 90% margin requirement, which is basically almost 1-for-1. And if you recall earlier, when we were looking at margin, leverage, and exposure, we did make the statement that really gross exposure is anything that you decide that you want. So even if the leverage is available from the broker, you may decide that you want to be somewhere here. So somewhere between 10 and 30% margin requirement. Because at the end of the day, you decide how much you put into your trading account and you decide what your gross exposure is. So when you're looking at these margin requirement numbers, these numbers can represent anything that the broker will offer you in terms of maximum exposure, but also it can represent what you want to do yourself. So let's start with the extreme example of 0.5% margin requirement, and that's equivalent to 200 times leverage. So as we did earlier in terms of working out the leverage, it's just 1 divided by the margin requirement. As you can see, 1 divided by G28. And the exposure, if we were to use the full leverage that the broker is offering us, the exposure is 6 million. And we work that out by taking the margin dollars that we've got in the account and we divide that by the margin requirement. This gives us the maximum exposure level that the broker is offering, or if we decided to take the whole lot. We assume that we're trading lots here. So that is equivalent to 100 lots. So we're looking at this number here, the 6 million, divided by 100,000. So that tells us how many contracts we're looking to trade. And we can see that if we actually did a situation in our trading account where we went long the currency pair AB, this is how much we'd be paying out per day in dollar terms. But if we did the opposite and went short the currency pair AB, this is what we'd be receiving. Now that doesn't mean that you should go out and open a 0.5% margin requirement account, fully leverage up to this number and just put a currency pair on that pays. Because as we mentioned earlier, it's not just about whether your account receives a net credit. It's also about the interest rate differential between the two countries and the speed and direction that they're moving, which is what we're going to come on to later. What we're doing here is introducing you to the principle of understanding and getting a foundation in understanding what carry and rollover is all about, and matching this up with a margin trading account so you understand what types of numbers can be made or lost if you actually just don't figure this out before you take positions. Now, if we go down here somewhere and we decide, for example, that we want 30% margin requirement, well, this is one contract because our exposure is 3.3 times leverage and our exposure is equivalent to one contract, one lot of this currency pair. And here we've got our daily rollover, which is the same as up here for one contract. So we can decide to be here if we want. So we can put $30,000 into the trading account on margin, and regardless of what the broker tells us, we can be here. And what we've done is we've marked up the leverage as red and blue. And really the red is where things start to get dangerous. And this is where things seem to be okay. This is where we have a margin of safety, where if we actually put these trades on, if we get paid a credit to our trading account, the currency pair would still have to move by 33% for us to be wiped out, which is very improbable. So we've also marked up this area here because the red zone, you can't really put these trades on because it's not equivalent to one contract or above. And here you can. Here, if you wanted to take these position sizes, you'd have to redo the whole table for mini lots, micro lots, and nano lots. And we've got the numbers here for you. We've just changed the numbers in the table for you so you can see how it all works. So let's have a look at this example here where we do 20%. Well, we could do something like one lot or 15 mini lots. And we could end up getting paid 13 of these currencies units per day. And if we're 20% margin requirement, so we decide that we want to be here and this is the exposure we're going to take, we can comfortably receive this per day and have confidence that it's very improbable that we're going to get stopped out or wiped out in any way on our entire trading account. So let's go back to the presentation. In your own time, go through that. It's pretty important to get this information sorted and know what you're doing when you're looking at carry and rollover, because many retail traders don't even check these things and they put currency trades on and they don't even realize that their margin is getting eaten away every single day by negative carry, and the currency pair can literally just not even move and they can be wiped out if they're obviously massively over leveraged. So looking at these things and understanding and even just appreciating them, appreciating that they occur, is just going to get retail traders out of bad habits. And we talked about this earlier. You know, one of the biggest mistakes of retail traders in the Forex market is just not realizing that more leverage doesn't mean more volatility in the asset class. We talked about this earlier when we were looking at margin, leverage, and exposure. And it becomes really important here because if you don't check carry, you can end up leveraging a negative carry when obviously the idea of carry combined with leverage is to leverage a positive carry. And the percentage return on an asset, any asset, not just the currency, is obviously a function of the volatility of the asset and changes over time. And the margin that you utilize in your account doesn't change because it's fixed by the broker. And more leverage just simply means more volatility in your P&L. So basically a very low brokerage margin requirement. It doesn't all of a sudden change the way euro dollar trades. It doesn't create a greater opportunity and greater volatility in the asset itself. And of course, you know, a totally amateur mistake is just not knowing whether a negative or positive carry exists. And a lot of retail traders get wiped out and are in this 90-90-90 because they literally have no idea what it means. And they don't even know where to check, how to check it, what it means. And they're just simply trading off charts. And they could literally be running positions for weeks and even calling the direction of the currency pair correctly, but not making any money because the negative carry and the leverage that they're using means they're paying as much in interest or more per day to run the position as they're making on the capital appreciation on the direction of the move of the currency pair. And obviously, it's even worse. If there's a negative carry, it's leveraged and the direction is called wrong. So you'll see in this 90-90-90 phenomenon that 90% of retail traders lose 90% of their money within 90 days. That's where the 90 days comes from, because they make mistakes like this. And they can literally sit in front of their screen the whole time wondering why they're not making money and start blaming people. So blaming the broker, blaming the educator who taught them how to do it. They'd be right if the educator was teaching them to trade off charts and didn't point them towards these things so they understood how not to lose money. And then when the currency pair basically goes against them, because they only have a small amount of money in their trading account, they just get a margin call and get wiped out. And this situation of not funding trading accounts with decent amounts of capital, so putting too little in your trading account and using a lot of leverage, this is another really obvious amateur mistake, because you can choose how much you put in your trading account and you can choose your gross exposure levels. Just because the broker enables you to do certain things doesn't mean it's right. It's just blatant greed if you put a small amount of capital in your account and you use the maximum amount of leverage to trade an asset and you really don't have a clue as to the fundamentals behind what makes that asset move in price. And brokers and educators love people like this because you're essentially the dumb money. They don't like retail traders who trade medium to long term and do it in small. And we say small because we looked at an example there that's 150,000. It's just relatively small compared to someone who massively over leverages and does the 200 times exposure or the position of 6 million. Retail traders don't like people who trade medium to long term in small to medium size for the positive carry. What they want to have is the dumb money who trades the 1 to 200 times leverage and trades the 3 to 6 million trade in and out. So they want you to day trade and do it before interest is paid or received at the end of every day, and to do it in as big a size as possible because they've got the volume spread, financing turn, and OTC conflict of interest. So they're getting paid and not you. Now, later on, we're going to be looking more at interest rate differentials and looking at it in the context of generating trade ideas from our tradable set. And what you've got to start understanding now is that in the real world, speculative capital is just constantly moving globally. It's liquid and it moves all the time, constantly. So it's not often the snapshot of the interest rates where they are relative to each other at this moment in time. It's the expectation of the future changes in interest rate differentials that matter in terms of creating the volatility or the big trading opportunities over medium to longer term time horizons. We briefly went over this a little bit earlier when we talked about the narrowing and the widening of interest rate differentials. Now start thinking about it in terms of the expectation of the narrowing and the widening of interest rate differentials. And theoretically, if you've ever heard of this, the efficient markets hypothesis, which basically states that all information in financial markets is discounted into the price of the asset already, spend some time online having a look at that. But theoretically, in efficient market hypothesis, the currency pair is said to have already discounted all of the information about interest rates and differentials into the prices of all currency crosses. So the expectation is that there is no positive carry opportunity. But that's actually nonsense, because the positive carry trade is one of the most popular trades in currency positioning. And a lot of people in the world, especially at the institutional level, because they're trading on fundamentals, get positive carry and do positive carry trades all the time. And what you're going to find is that it's really the changes in interest rate expectations, so the positive and negative shocks to the market, that create hot money speculative flows in and out of currency pairs, creating the volatility and opportunity. So interest rates become a very important driver in our overall systematic process later, because hot money, the speculative money, will follow the positive carry and migrate away from negative carry. So if expectations of interest rates are set to narrow, hot money will flow out of the negative carry. And if interest rate differentials are expected to widen, hot money will flow into the positive carry. So we have to keep that in mind. It's all about expectations and all about interest rate differentials and the direction and speed at which they're going. So we'll be looking at this much later in our trade idea generation. But for now, we've got to understand in a static sense how this actually works in order to ensure that we've got the foundation and understanding of how this works, so we can move forward onto the systematic process and get a bit more in depth and a bit more complicated later. We've been through a lot of basic computational methods, and just as a reminder, we've been through the left to right convention, we've been through pips calculations, percentages and basis point calculations, we've looked at the various trading sizes within the Forex market, so our standard sizings, we've looked at margin, leverage and exposure, we've looked at profit and loss calculations, and lastly, we looked at the really important carry and rollover dynamic. I think we've learned quite a lot here in this section. So let's go back over to the trading desk for a quick recap and summary.
Okay, so welcome back to the desk. What you saw there were the basic computational methods that are a set that we can rely on as traders to call upon if we need to in regular day-to-day dealings and transactions. How does this all link together in terms of our foundation? Well, when you think about it, we looked firstly at opportunity set, and we looked at regimes as well in video number 1 and video number 2. And when you link all of this together, the mathematical rigor of understanding the mechanics and the numbers and the basic computational methods in Forex, this all links together with opportunity set and regimes, because we need an appreciation of volatility. And we went on that journey through opportunity set and regimes in actually understanding how we get to a definition of a tradable set of currency pairs as professional traders. Now, also, when you look at infrastructure, so in video number 3, having a solid foundation in the basic computational methods is essentially really important, because in infrastructure we realize that hedge funds and investment bank prop desks and even pension funds take a very fundamentally driven approach, whereas retail, who are very different in their approach, tend to use some basic computational methods and mostly technical analysis and maybe even trading off some sort of economic indicator. And because the approaches are different, what you found in basic computational methods is that they're not actually that basic at all. The basic computational methods that we looked at, they're called basic because hedge fund managers pension funds and investment bank prop trading desks, the pros, the professional traders, go much further in understanding and having mathematical rigor than retail traders actually do. And retail traders, as we said right in the introduction of video number 4, retail traders for some reason think that if they have some understanding of basic computational methods combined with technical analysis and calling a direction on economic numbers, they think that's enough to rely on to be consistently profitable. Well, you've got to start thinking of this in terms of a competitive market, because the Forex market, like any other market, is competitive in 2 ways. It's competitive in terms of the product itself, so we're trading Forex and we're all competing with each other for profit. And in this instance, the minority make money, the majority lose money, and the majority who lose money are retail. But you need to think of this in competitiveness as well in terms of a labour market, because if retail traders are at this level, and this level of understanding, the pros will always make sure that they're much higher at this level. And this is what it comes down to. Basic computational methods links to infrastructure because the pros just do it differently. So we're linking basic computational methods with opportunity set and regimes because we need mathematical rigor. But the mathematical rigor also sets us apart as professional traders from retail traders. And the basic computational methods that you saw there, what you will probably realize is that the vast majority of retail traders only understand a very small part of that. So they think understanding a very small part of it, plus technical analysis, plus trading the direction of an economic number is a trading strategy. It's not. The pros do it differently, and they always make sure they're higher and better. And now we're going to move on to video number 5. And video number 5 takes us again on this theme of volatility. And the basic computational methods are important to know before you move on to this, because now we're actually going to move on to advanced computational methods. And it can be a little bit daunting, because we're going to be doing a lot of spreadsheet work here, but take some time to really get into it, because once you know how to do this, it's a rinse and repeat process. You can use the same process over and over again across Forex and across multiple asset classes. Okay, so let's go over to video number 5, and I'll see you on the other side.